So if you want to be rich, do what rich people do. Invest in yourself and invest in a business and invest in real estate.
What we're talking about is the infinite banking strategy.
Everyone's like, oh, it sounds like you just keep re-leveraging yourself. Well, that's what you're doing in real estate. You're basically borrowing your next down payment from your current property. Go out and reinvest that money and make money off of that, while your original cash is also making money.
And this is what finally got me excited about like insurance. There's $100,000 in there. It keeps growing while you just borrowed $90,000. It's like, oh, that's pretty damn cool.
When I was broke, I had rich habits. When I was broke, I had rich habits.
All right. Welcome to the Master Keys podcast.
Yeah, we don't know what episode this is.
It could be episode 3. It could be episode 5.
We have a guest on this week's episode that we're super excited about. That's Darren Mitchell and Christina Wyatt. They're from Control and Compound. Yeah, so which is both a financial advisory, financial guidance company, but they also run the podcast Control and Compound, also at BNV Studios. So we're going to switch to that interview in the second part of this episode. But first, we're going to start with a few different things just to kind of catch you up on what's going on in the news. We got our key player of the week. We got some Q&A questions you guys asked us. We're going to respond to those right now as well. Neil, what's shaking, man?
We have to go over our 5 new subscribers.
Yes.
So we'll say them real quick.
Yeah.
Thank you, Jesse Rios. Thank you, Gumby1. Thank you, Vikas Ravendra.
Yep.
Thank you, Kawashik Roy.
Yep.
And I'm butchering these so bad. Last but not least, Carrie Ottaway.
And I think there's a couple others after that. Let's keep it going.
No, I'm not reading the rest of those.
Okay.
They're too hard to pronounce.
All right.
But so thanks for subscribing, guys. The first thing I want to get into right off the hop, Chandler, is you called me as we were driving here, and we're like, market's picking up. Everything's going really good. Things are ticking. I want to talk about it. And then I said, And
he was like, I don't know. And then I'm like, what are you talking about? And he's like, I'll tell you on the pod. So this
explain your feeling. You got a feeling.
So no disrespect, I'm out here in these streets a little bit more than you, Neil. Okay?
Guy slows down on the real estate sales. He's coming at me already.
No, so I probably, listen, we're a few weeks into January. Actually, when this episode airs, we'll be through January. We'll be into February. And that first couple weeks of January were, how would you describe it?
Dead.
Death. Okay. And we're coming out of November and December that were also very slow, which is part of why January felt slow. And always when the year starts, a few things happen. One, the buyers are ready before the sellers. Because buyers show up there January 1, they're like, all right, let's go, man. New Year's resolution. I got some money for Christmas. I'm ready to go. But the sellers are not. The sellers are coming out of the doldrums of the holidays. They're thinking about how the home looks better in the spring, et cetera, et cetera. So immediately,
calendar switches over.
Yeah. A few weeks into January, we started to see that the buyers were there and the listings were not.
Yeah, okay.
Simple supply and demand. A couple listings came on, and it was still feeling out like, what's the response going to be? And man, I probably attempted to book around 15 showings or so in the last 7 days, maybe a bit more. Okay.
What's your norm outside of this? Typically?
In a week, I'll probably do not much more than that, like 20 to 25
during the height of the busyness.
Yeah, because there's still low inventory then too, right?
True. Okay.
That's
so usually I'd say 25, and right now you're doing 15.
Yeah.
Okay.
Yeah.
All right.
But no, I wasn't doing 15 because I attempted to book them, and of those 15, probably 6 or 7 were already sold before I could book the showings on them. Of the properties I did successfully show, we were in multiple offers in a property on Spryfield, which we got. We were on multiple offers on a property in Dartmouth, which we didn't get. There was 3 on the one in Spryfield. There were 9 offers on the one in Dartmouth. Then there's another one in Dartmouth that we were one of 6 offers. And then I was in one last night, kind of out past Elmsdale area, and there were 6 offers on that.
Oh, where I live.
Yeah, way out there, no reception where Neil lives. And I'm trying to think, and there was one other. So these are properties
we were in
selling
competition and we didn't
multiple
know it.
offers on a lot of these things if the homes are still available. So that is enough of a sample size that I can already tell there's some momentum that's going on in the market right now. Let's hear it, Squinty. Squinting over here at me.
So yeah, I agree with what you're saying. There's definitely a little bit of a pickup, but I feel like it's a blip.
How many showings did you have last week, Neil?
1.
Yeah. So who's out here in these streets that knows what's going on with the market?
To preface that, I've stopped selling real estate. If it's your first time listening to the pod, we have a team now, and Neal doesn't really sell real estate unless it's a commercial property. But I got a lot of messages last week, and I can tell that a lot of the group chats are picking up. And so I'm seeing that, and I can see like the stats, and I can see what's going on in the office, and then I'm listening to you. So I believe that there's that uptick, but I believe it's like a blip.
You think that's just because of the sheer low of inventory?
I think it's sheer low inventory. Then I also think it's like the week after New Year's is just fuzz. A lot of people are still on vacation. The week after that is literally still fuzz because people are starting to get into the routine, get back at it. Weather kind of sucks, like all those things. And then I think at this point now, this third week, like that mid-second week and the start of this third week, people are all fired up because now they're back into the routine. They're bored at work, doing whatever they're going to do. Or they had their New Year's resolution. Some of you guys heard mine. That was to buy a property in the States. I have now started shopping in the States. And so I think all these people may have come out with a New Year's resolution to like, this is the year I get myself a house, or this is the year I get a rental property, or this is the year that I get my next rental property. And so everyone's coming out fired up. And so we're right at that point. But I do think like we have another rate hike coming at the end of the month, or by the time this is out, we probably have had that rate hike.
Probably another 25 points. We'll see in hindsight. But
yeah. And again, it's like that same concept that we've talked about 100 times where everything is like a delayed response. And so we've had the hikes now for maybe 6 months is kind of where it started, 7-8 months maybe.
Yeah.
So it's like we're just at the peak of it. Like in another 6 months is when we're really going to start to feel the pain. So I feel like there's more pain to come, right? Like I feel like everyone's kind of probably seen the charts somewhere, whether it's on YouTube, Instagram, the news, everywhere. There's something being talked about how the market's going to zero, and I don't think it's going to zero, especially not in Canada, and especially not in Atlantic Canada. But I do think that like there's a little curve that comes down, and then there's always a little blip. It starts to go back up, and then it falls off. Like it never just curves over the highest price point and then goes straight
you're
down.
Talking about the real estate market, or you're talking about
real estate market? Yeah. And I don't think it's never just a smooth descent. Similar to how it's never a smooth ascent, it's never a smooth descent. And I think like this is just a small blip.
But what
I don't think it's an indication that now the market's back off to the races. And I know inventory.
I'm not saying back off to the races, but I'm saying it's not quiet anymore, right? Like if there were
for well-priced properties,
if there were more properties on the market right now, I probably would have 4 deals that I could do in the next week. Right, like I've got buyers ready to go, ready to pull the trigger. And part of the what's going on, because we were saying that yes, the buyers come, they're ready to go early in January. There's no, it takes a while for the sellers to come on. But a lot of these buyers, if you take first time buyers, they don't have the frame of reference of the 2.5-3% interest rate anymore, right? There are some buyers that in the fall of last year were like, man, I can't believe the rate now because I used to have a rate hold at this, or my friend who just bought had that rate, blah, 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 blah. These are new buyers who they're going in, they're saying, what's the best rate available? Which right now is low 5s, right?
Yeah.
Maybe 4.99, but most likely low 5s probably.
Yeah.
And they're like, cool, how much money does that get me? Gets me that amount? All right, let's go shop. They're
so
not having
there's
this
just that many buyers, and there's still such an inventory crisis. It's just going to persist through. Like
I'm not saying to the degree that it was at all, but I'm saying it is not. Like last week,
I was supposed to have a showing, but it's same thing actually happened. I went to go book it, and they had 3 offers.
Yeah,
and also the other one I went to go show you, and I actually were competing in offers.
Yeah. So,
without knowing.
I mean, you take this sample size, and it's not huge, and early in the year here, all of the data is a little bit skewed. But between the two of us and what we're seeing out there, that's something.
Yeah.
Right?
My thing is, I guess, outside of here, I just foresee there to be more pain.
Outside of
American
Halifax,
market, I'm expecting a ton of pain. I was talking to somebody actually about, like, Costa Rican real estate, and they said there's a ton of pain there.
Ooh, La Pura Vida. We haven't talked about Costa Rica in a little while. Costa Rica is my favorite.
Yeah.
We got to do it. This is the year.
I know. We're
going to shoot an episode down there this year.
We are. I was booking something right before I came here. I'll talk to you after. So I don't know. My thing is I just think there's going to be like at least some stale pricing for a bit. This might be a little bump, but it might be an opportunity to sell. And I don't think it's a bad time to buy either. But I just see I still see aggressive price drops on overpriced real estate, and some people like things going stale, and they just never marketed it properly from the start, and so they're selling under value. But I do agree with you that some stuff is still going nuts. Like I just don't see it going up. I guess my thing is I can't see it going up from here because we haven't felt the pain yet from the rates.
Okay.
On everything outside of real estate that's going to ultimately impact real estate. Like when you think about where's
I hear
money going to come from?
I hear what you're saying, and I think
They're withdrawing
also
all the cash out now. This is the economic policy. Like the idea for them. So they injected all this money in during COVID. It pushed everything up, inflated everything up. Now rates are one way of reducing the spending and pulling money back, but they're also like CRA is like increasing their task force immensely to try and pull back and reclaim a bunch of falsely claimed money during COVID. They're being really aggressive with people who owe taxes to recapture their taxes. The government's doing everything they can to pull money back in, and that's even why you're seeing tax hikes across the board, because it's all in an effort to bring down that monetary supply again to a normal level. And not a ton of people are talking about it, but monetary supply is shrinking rapidly, which I think that's ultimately, you're going to start to feel it where people are just like, hey, I just don't have that much cash available anymore.
Yeah, no.
Like, where to go?
I agree with you.
I feel like
I think there are leaner times. I'm just saying, at least in this moment, the consumer confidence that was the lowest it's probably been in 3 years in Q4 of last year.
Yeah.
It's back. Like, none of these buyers are boo-hooing about their rate or anything like that. They're out there to buy. Now, the other thing I will acknowledge is that is more at the lower end of the price point, which in our market here is sub 500.
Yeah.
Right? Because more people are being pushed down to that price point because of these rates. So there's more buying pressure at that point. But that's what's going on super hyper locally here. You've got another cool story that I wanted to
Yeah, I mean, cool or like kind of scary. I guess depends how you look at it. But
Scary can
it's
be
been
cool.
sent to us a few times by one of our team members, Angela. Shout out for Angela. But I've also seen it at a bunch of other places. And this is where homes effectively are being sold out from under an owner's nose without them knowing.
Yeah.
So you imagine just showing up to your property and there's like a family living in it, and you're like, wait a second, what? And you were either out of country or as an investment property or secondary or whatever it was, and now it's been sold. And you go and talk to them and like, oh, are you guys squatting in my house? And they're like, no, we paid $1 million for this home. This is our home now. It's on title. And you're like, what the hell? And so what's going on? There's a private investigation firm looking into it in Toronto, but it's estimated that 30-ish homes have either been sold or remortgaged without the actual owners knowing.
Wow.
And so the way that they're doing this is it's identity theft of the original owner, because you can look up whoever owns it.
Yeah, this was going to say, how did this make it through the process that no lawyer noticed, well, that's not the right people on title?
But it's not that hard, really, when you think about it. Like,
identities,
especially now with like Zoom calls and everything, they provide us is a driver's license.
Man.
So what's happening now is they will find out the name of the owners through whatever online system is available, because in Canada it's public. They will then create fake identities for them. They will send in a set of like hired, I'll say hit people that go in for $5,000, and they will pose as tenants to rent the property if it's available to be rented. They'll rent the property so they have access to it for showings, staging, all that kind of stuff. So they're picking homes that are up for rent.
Okay.
So they're picking a home that's up for rent. They're finding the owner, stealing the identity, paying someone $5,000 to go pose as tenants and sign a lease, and then they're using the fake identities to then remortgage that said property
Or sell it.
And they're immediately taking the cash from those. Like they said, if they list it, the first offer that comes in, boom, they take it. They take the cash, and they're transferring it out of their bank accounts instantly. Like they're basically setting up bank accounts primarily for this one transaction. Money hits the account, money gets transferred out, closed, gone. And so they're trying to basically figure this out, because they've arrested multiple people. They've been able to find the people who are doing it, because there's physical people that are writing
Like
these
the
leases.
tenants and stuff like that.
But every time they get them, they're like, oh, you're just somebody that got paid $5,000
to go rent this place.
place, and they said they'd cover your rent basically, and you had nothing to do with the back end operation. So it's actually fairly clever. But the bigger thing that's coming out of it, obviously, is people are losing their homes and all that. But what we rely on so heavily here is title insurance. Every time you buy a property, it's like, oh, it's $180 for title insurance, and a lot of times you don't necessarily think much about it, and it doesn't really come up often. But now they're talking about how title insurance either becomes ungodly expensive or just goes away altogether.
Oh, it's going to have to go up for sure.
Because they're basically saying they used to get zero claims effectively.
Yeah. So
now they've gotten hundreds of millions of dollars of claims in the last few years.
Everyone listening to this probably has paid for title insurance at some point in time, but maybe doesn't know exactly what it is. Effectively, title insurance is required by your lender. You can either get title insurance or a location certificate. Depends on the lender. Yeah. But title insurance is effectively an insurance policy that in the future, if your clean title to the property is contested or proven to not be legitimate, you have an insurance policy. So say you buy a property and then someone comes out of the woodwork and says, well, wait a second, I'm the long lost heir of this lineage, and that property should be mine. Or someone had a lien registered on the property that you weren't aware of, and then you took title thinking it was clean and it turned out not to be clean title. These are the sort of things that title insurance could protect you from. In this particular case, it's preventing you from the fact that like you bought and thought you had clean title, but you didn't because the person who signed off on that title was not the owner of the property. So that's what title insurance is. These are going to be massive claims because they're going to be $1 million claims.
Oh yeah, in Toronto, every time
Yeah.
it's been, they said literally in the last 2.5 years, it's been $200 million in claims. Before that, like when they first started doing title insurance, it was literally never a single claim.
Yeah.
It kind of makes sense. Like I always thought it's fairly archaic in some sense that all we give them is our picture of a driver's license, and then you sign a piece of paper, and
Yeah.
now you own this property. Now you're able to transfer mortgages.
But what are they going to do?
around.
Like a DNA test, man?
This is the kind of stuff that lends itself to these online like blockchain-based systems of selling real
that's
estate,
true.
like having a chip in your arm. I don't know what they're going to do
Neil's
to
back in
to
the
verify.
NFTs over here.
This is it. This is where NFTs and all these the crypto.
No.
This is where they gain their legitimacy, and like this stuff.
Until someone like steals these crypto or NFT wallets and then they own all of Toronto. Yeah.
Literally, and that's the problem that happens with every crypto thing. Is then the person who like the guy who's stealing these, like he's like, I'm selling all these houses. He's like, what I'm going to do now is I'm going to create a crypto that people think is safer to protect them from me, and then I'm just going to steal everything from the crypto. And it happens every single time. But at some point, if the government can start to legislate through technology, I think there'll actually be an opportunity for it to make sense and be a lot safer.
So there were a couple of rental scams also going on here that were similar in a lot of ways. So you'd list a property and if it was vacant, then someone would notice the ad, they would take the pictures, and they would run an ad to rent the property. And they would rent it at like a deal that was almost too good to be true.
Yep.
And effectively they would say, hey, in order to be considered for this, like send us over your application. Oh, we think your application looks good. We'd willing to meet with you, but before we meet with you, you have to fill it, like you have to submit a deposit before we show you the property. And of course, there was no property available for rent. They would just take the deposit. I knew about this because a lot of people would call me like, hey, I'm looking at this property for rent, but I see it's also listed for sale. You're the listing agent. Is it for rent? I'd be like, absolutely not. Don't give that person any money and report it.
Yes,
but that was going on for a while. Then there was another one where someone had gotten access to a couple units somehow. I don't even really know. And they would actually show the unit and, sign a lease with someone, collect a deposit, or in some cases, deposit in the first month's rent. And then there would just be like, no, like that unit wouldn't actually be available.
You're really well versed on these scams.
Well, I mean, I'm out there in these streets, Neil.
Oh,
so,
yeah. Okay. All right.
Anyway, so it's always terrible to hear that stuff come up, but then it, leads hopefully to some new innovations with safety and security when it comes to that stuff. But
I remember seeing those a few times, exactly, where they have a rental ad on Facebook Marketplace, Kijiji, or wherever it is, but they used the photos from a listing cut. So I'm like, damn, those are nice photos for a rental ad. And I'm like, oh, wait a second, that house is up for sale.
Well, I've
I'd
had a bunch of people recently offer to rent places without seeing them. And it's like, oh my gosh, like you could easily keep these people's deposits just by running these fake ads. There's such a desperation for units that don't do this.
Yeah, I know. I'm like, you're kind of selling it here, Jerry.
Yeah, let's just like crop this out, make this a short
Don't do
video,
this ad.
like how to run real estate rental scams. But
All right, we're in that other studio for a bit, so we're gonna before we transition over, we're gonna give a shout out key player of the week.
Oh yeah, key player of the week, and we also have a couple questions that we're gonna answer.
Yeah, that's gonna be at the end of the episode.
Okay, cool. So key player this week actually is a buddy of mine, Elliot MacNeil. You guys might know him from around town. He's actually from Cape Breton initially, and he started off in marketing.
One of the buys.
What's that?
One of the buys.
One of the buys, man. Super, super smart guy. And he got into real estate after previously working in the marketing world. And he has done a lot of stuff in downtown Dartmouth. Like you could make a strong case for him almost single-handedly revitalizing downtown Dartmouth.
Yeah, 100%.
If you think of some of your favorite restaurants and places in downtown Dartmouth, like, the Canteen, Side Hustle, like all these spots, those are actually in properties that Elliot owns and has developed.
Yep.
And part of what he was so good at is because of his marketing background, he could really pitch the finished product, both to lenders and to investors. And this is something we've talked a little bit about. If you're going out there trying to do these big renovation projects, because he was doing infill new construction, he was doing substantial renovations to projects. To finance them, you have to sell the lender and any investors on that finished dream. And he was great about that. And then he delivered through his company, which did the development, but also is a contracting company, Bruno Developments, and then now he's doing conversions under another company with a partner called Sidewalk Red here around town.
Yeah, I'm gonna hype him up with just a couple things. I don't know what awards he has, but I imagine a ton because his builds are amazing from conceptual to actual finishing. He's done some neat projects downtown Dartmouth, like he bought the old Bell building and
Yeah.
put an apartment
The
building
Bell
inside of it
Lofts
that
there.
goes
Yeah.
up on top. Unbelievable, very cool building. We'll flash a photo of that up. He's definitely revitalized like a bunch of Portland Street. He has another project under the go right now where he's converting a hotel into apartments, and it looks amazing.
Yep. Those are these micro suites that we were actually supposed to go through and shoot some stuff there. I reached out to him before the holidays, but then things got crazy. I don't know if those are taking occupancy now, but we're talking like a really innovative micro suite model with like Murphy beds that were custom built, a really cool atrium space so that you don't have you don't have a living area in your unit, but you have a common area in the building. I really hope we get through that because it is super, super cool.
Super neat building. He's also doing an office to residential conversion in
Right
downtown
here,
Halifax, right across from us. So yeah, very neat, interesting guy. We should definitely have him on, and we should definitely go visit some of his properties. But Elliot MacNeil is our key player of the week.
I'm going to give him
Shout
one
out
last
Elliot.
little
One last
thing.
tire pump.
So I met Elliot because I saw what he was doing and I thought it was so cool and it was very much what I wanted to be doing. And I reached out to him on LinkedIn and he said, no problem. I was like,
Crazy.
can I just pick your brain?
You
And
just blew up his LinkedIn, by the way.
oh God, yeah, sorry, bro, that's not good. But he was just such a genuinely great guy, and I've said this before. Anyone who's actually doing things and is actually successful, as much as they can, they're going to be generous with their time and their information and helpful. And I know it meant a lot to me when he took the time to chat with me, and he continues to this day to take my call when I have questions. And yeah, just a great guy. So Elliot MacNeil. Key
Hopefully
player of
we
the
can
week.
get him on so we can
Yeah. I'll
share
send
some
this
of his
to him, too.
insights on how he grew his business. But
Yeah.
for now, we're going to hop into the other studio with Darren and Christina,
Okay.
talking about how to get infinite banking,
Yeah, excited about this.
infinite money.
And this is going to sound like one of those things where a lot of maybe the younger listeners out there aren't going to be excited about what is ultimately an insurance-based product for financial planning. But it has a real estate component. It has a private lending component. It has a leverage component. It is super cool. So check it out.
All right, so thanks. We're switching over to Studio B here for the second half of today's episode. Thanks so much for listening. As always, like, follow, subscribe, press the little ringy button. We've got our guests on today, Darren and Christina from Control and Compound. So I know you guys as our kind of fellow podcaster here at BNV, but tell us a little bit about yourselves and your background.
Sure. So I grew up in the city here, and then I ended up living in Toronto for probably 5-6 years, various couple different stints. But yeah, grew up in Dartmouth, economics degree, MBA, CFP, CLU, all those fancy letters after my name, and then I did all that so I could sell life insurance. But we're financial planners, but our firm specializes in this high cash value life insurance stuff for real estate investors that we can get into today. But married, couple kids, good life.
What about you, Christina?
Yeah, same here. I was born and raised here. Well, actually not born. Sorry, I was born in Ontario, but raised here pretty much my whole life. Live here locally as well. I've been in the finance business for about 12 years or so now, but in the last 5 years really took specialization in infinite banking. But again, I'm a certified financial planner, chartered life, all those little letters that you got to get there.
Yeah.
But now put a real focus on that infinite banking side of things. Working with real estate investors and business owners is another big one on that side of things.
I'm super excited to talk about this, but I got a question for Neil before we start this.
Okay, go ahead.
Neil, how's your life insurance situation?
It's actually not bad because I do have it.
Okay. The reason I ask is because life insurance has to be the least sexy thing imaginable. And I always thought we're so fortunate because we're selling the product that everyone wants to talk about, which is real estate.
Yeah.
Right? People who sell
You can
insurance,
see it, you can feel it.
my God, man, that's got to be the worst. Like, all right, so in the event that you die, like it's a tricky thing, and
You make the most money when you're dead.
I know. I'm like, my wife is going to be loaded when I die.
I told my mom that after I signed. I went home. I was like, "You're set up. You're set up."
Cake out, Mom, if this car runs me down.
Well, I tell my wife, I said, just do me one favor. I've got so much life insurance. And again, we buy it for the cash, and life insurance is a bonus. But I've got so much. I said, promise me one thing. At my funeral, wear a veil so they won't see you smirking. Because it's going to be a good payday for her.
Well, why this is so relevant to our audience and why I put Neil on the spot there is that I know we all go out there.
try.
We leverage our properties to buy more properties.
Leverage our life.
And you always have that option like, would you like to click the mortgage insurance with this mortgage product? And anyone well, I certainly never clicked that, and there's all kinds of reasons. Maybe you guys can say why don't take the mortgage insurance, replace it with a different product. But ultimately, a lot of people say no thanks to the life insurance that comes with the mortgage, but then also don't go out and get their own life insurance product. And they tend to be younger people, because I was young one day, and I always was a little bit underinsured based on how many mortgages I had out there.
So one of them, I got the application for the insurance, and I found it got kind of expensive. Hence that's why I bailed on it a lot of the time. But this one covered that if I had any serious illness, and it like listed them under there, and one of them being cancer. And not to joke about cancer at all, but I was like, man, I probably won't get it at this age. Hopefully, knock on wood. But maybe if I take this loan and then I microwave my finger, I can get like skin cancer on my finger. I'll go in and they'll wipe the mortgage. Because I called them, I was like, will this wipe the mortgage? And they're like, 100%. Like, we have clients that have gotten cancer, unfortunately, but then we wipe their mortgage to zero. And I was like, all right, let's see
You're
how
a
I can
psychopath. But that's interesting you mentioned that, because I remember when people first started pitching me, life insurance products, so boring. The only two that have ever gotten me interested, and this I think is what you guys are going to talk about with your infinite banking, because we're excited to see or to hear, for our listeners to hear what that's about. The only two that got me excited was critical illness and disability, because I was like, all right, I'm probably not going to die at a young age, right? Knock on wood. But sometimes stuff happens from a critical illness or a disability component. So maybe I should be covered for that. But also the fact that some of the products you can roll over into your RRSPs down the road or get some of the money back. I'm like, so I can pay insurance and get the money back? Because a lot of people look at their insurance bill, and if you don't have to use it, you're like, damn it, I wasted all that money. Now you guys are going to talk about these strategies where you actually get to use your insurance money, which is super cool. And that's the only time I've ever otherwise been excited about insurance, are these whole life policies. And I don't know what I'm talking about, but you guys are going to explain it better, that you get the insurance and you get a cash value. And what's crazier is you can borrow against the cash value of
Leverage.
it, tax free. So like, did I hear borrow? Did I hear leverage? Like that, I understand. So we're going to talk a little bit about that.
Yeah, I also, the way I got interested is I had, because again, especially in your 20s, people aren't really talking about it. And I don't necessarily know, you guys probably do try and pitch to 20-year-olds, but it's hard when they don't necessarily know what's going to be in their future. And sometimes it's hard also, like, what do I really need this for?
And do I have the extra money month to month to put away? And,
Exactly. But I had a friend, Rusbe, actually, I'll call him out. He works at CIBC. I think he's in Woodgundy, and he is a financial advisor. And he was like on me. He's like, man, you got to get into this. You have a lot of debt. And the big thing to consider is, and I think some people forget, is there's a tax liability associated with properties, because over time you're consistently writing off, you're depreciating your property, which means that's how you save on paying taxes on the immediate day-to-day basis, and that's how you're able to make money off of them. But it means when you go to sell, there's a big tax liability with those properties.
Yeah.
Or if you die and they have to be sold, there's a big tax liability that gets passed to the next person in your family or whoever your spouse or whatever it is. And so this is where the insurance can come into play, is it can help to cover some of that or potentially all of it, depending how much you buy, plus the additional things that Chandler talked about with being able to pay into it and then borrow back a certain portion of it, or potentially eventually more than you've put into it. And so again, I'm not an expert in this by any means, and I do find it a bit confusing. So hopefully you guys can help to demystify it for us and our listeners.
Yeah, so let me tell you just quickly, half the people we deal with that we deal with, this business owners, real estate investors, wealthy individuals, they don't need insurance. Okay.
Yeah.
This is a want, okay? Yep. Because this insurance is going to benefit you in your lifetime. You buy this for you. You buy term insurance for your family if something happens to you. You buy this for you or you and your spouse. This is really benefit. But you mentioned the mortgage insurance, and Christina, why don't we just do sort of a minute on the mortgage insurance? Because, to sum it up, bank-owned mortgage insurance, evil. That's pretty much it. But Christina, you can dig into the details. Why should nobody have mortgage insurance if they're insurable?
Yeah, you were not wrong there. When you purchase life insurance through the banking or through the lender, what happens is it's a very easy sign up. It's actually more expensive at the end of the day than your personal stuff that you can purchase. But there's a couple big differences that you want to be aware of. One is that you're paying for a death benefit that's decreasing with the mortgage. So say you have $500,000,
Right.
You're paying for 500,000. If you only have 300,000 left, they're only paying out 300,000. So
Yeah.
you're paying for something you're not necessarily going to get,
Mm-hmm.
which is a huge one. Also, like, you don't own it and you're not the beneficiary. So you're protecting the bank at the end of the day. You're not protecting
Yeah.
your family, because that check is just that's just clearing the mortgage. They're covered. When you purchase, a 500,000 personally, your family's going to get that 500,000. They can take the 300,000 and pay it off, keep that 200,000 difference, or they don't even have, they could sell it if they wanted to. But the biggest one that really gets me with that insurance is that they don't actually approve you for it until after you die. So
And they look at
if
you retroactively and be like,
you
what was this
literally
hooligan
sign
to?
up for this stuff, and then you think that you've got it in place. But let's say you die and they go back and they look at your records and they're like, actually, we wouldn't have given you this insurance anyways. We wouldn't have done it.
I'd be like,
They're not gonna,
delete my skip the
that's-
dishes
I
orders.
was
today.
like, based on Neil's driving record, we can no longer insure him.
No,
Well,
you
but
say this in
it
jest, but it
happens.
is true, right? You
Yeah,
just tick
it
the box and like,
happens.
okay, we're going to charge you probably, I don't know, like 20% more for a product that if you had a mortgage for $300,000 and you opted for the life insurance and you've paid your mortgage down to $250, the product you're paying the same amount, but now it's only worth $250. It's not worth $300 anymore. Like it makes no sense.
Picture if you made a lump sum on your mortgage of 50 or 100 grand, or paid something off, and then all of a sudden you die. You just gave the bank
Yeah.
50 or 100 grand. Like that's just, but that Christina's great point. Like underwritten at time of issue versus underwritten at time of claim. And that's what the bank owned insurance is, underwritten at time of claim. So some teller asks you some questions, you check no. They put it in a filing cabinet,
Doesn't
wait
mean
till you
anything.
die,
No.
then they pull it out and go, okay, do we have to pay this claim?
Yeah.
Versus, which in about, depending on who you listen to, somewhere around 20% of claims
pays
claims don't
out
get paid.
pays out a lot lower.
If you deal with a
yeah.
licensed insurance agent, you buy typically like a term 20 or some kind of product like that. Very inexpensive. It's cheaper, but it's underwritten at time of issue. So they're going to ask you medical questions up front, and they're going to approve you, and you're approved. There's no going through the file if you die in 5 or 10 years. There's no fear of you get approved and then you start smoking 5 packs of darts a day and doing whatever. It's not going to change. Okay, so they can never change it.
Which is why I think if you're in a position that you can afford it at a young age, it's best to go in because your premiums can be really low and it's really easy to
Totally, that's that
qualify
too.
because you pretty much are a no to everything. One thing I want to add to what you said, Christina, was something for people to consider. And I always say this with everything we talk about on here, but when you go to the bank, your advisor or whoever's giving you that mortgage is going to say all the opposite things. You're going to go, hey, I heard on the Control and Compounder on Master Key's podcast that I shouldn't be getting this. And they're going to push so hard to sell you on that product. And it's because they either get bonuses based on it or it hits a certain production target that they need to meet. I won't say who, but I have a friend in the bank that has done some mortgages for me. And what we'll do is I'll sign them up and I'll take the insurance product on the first day and then I'll cancel it the second month. Because he's like, man, I get a bigger bonus for you just signing up to this thing, and then you can cancel it in 2 weeks. I don't give a crap. But anyways, not calling out who it is.
So yeah,
but
if
they
you're
will
listening
push
to
it
this
hard.
and you only take one thing from this, is that
Banks
take
are
two
evil.
Take two things from it. One, if you tick yes on that box, know that you should be canceling that and going out and getting a better life insurance product.
Getting approved first before you
yes,
cancel.
don't cancel
Yeah,
things
yeah.
until you get a new policy.
Yeah, make sure you get a new one kind of ready to go first. The other thing is that when you get these younger, they are cheaper, right? These term policies, they are
Way
cheaper
cheaper,
when
like
you're
way
younger
cheaper.
and healthier. So if you take nothing else, take that. But what we actually really want to get into, which I think is way more exciting, is this idea of infinite banking. So tell us how this epiphany came to you at some point, which was maybe the impetus or the catalyst behind this book being the bank. And then you got more specific with the infinite banking.
When you were
for real
growing
estate
up and you figured out that you wanted to sell insurance.
Yes, yeah.
Yeah. Well, I know a lot of guys in my MBA class at St. Mary's said, hey, let's get into the insurance world. No, so I started out in the financial planning world, and, I was a regular financial planner for years and had a successful practice. It was nice. For me, the really aha moment was 2008. So I'm old enough to remember that crash of 2008. I remember exactly where I was and what I was doing. I was in Alaska with my buddy salmon fishing, and life was
What could
good.
go wrong?
Well, I'll tell you, I sold it to my wife. We had young kids at the time, a once in a lifetime salmon fishing trip. And then I went like 5 times. So one of my buddies threw me under the bus on one of those Christmas letters. I went on Mitchell's once in a lifetime annual salmon fishing trip, is what they called it. But I'm up there in Alaska, and all of a sudden the market started crashing, just crashing, fall of 08. And it's just, it's a mess. So back then, taking my BlackBerry, driving to the hill on his truck, trying to get reception saying, how much did the market drop? How much did the market drop? And for me, that was like, oh my God, that was the first kind of down market for me in my life. And it was like, I'm totally out of control. I don't know what to do. And my clients, I'm not in control of their money. The market's free falling.
Yeah, you
there's
have no answer.
nothing
It's
you
just-
can do. For me, that was there's got to be a better way. So I went and spent a couple $100,000 traveling around North America. I heard you guys talk on podcasts about mentors and how wealthy people will share information. I was blown away. They were like, well, this is what we do. This is what we do. And a lot of them just coming back to this infinite banking or high cash value life insurance, which is a totally uncorrelated market that doesn't drop with the market, that doesn't go there. And then what I really, my takeaway from that education crusade was, if you want to be rich, do what rich people do. Pretty simple. What do rich people do? They do 3 things better than anyone else. They invest in themselves. Listen to a podcast. Learn how to be a better real estate investor. Work with the right people. Join a real estate investing group. Get your engineering degree. Whatever it is that's going to get you ahead, invest in yourself. Rich people are not afraid to spell on that or invest in that. And then they start businesses. And number 3, you guys, they buy real estate.
Yeah.
So if you want to be rich, do what rich people do. Invest in yourself and invest in a business and invest in real estate. But Christina, we always talk that where to get rich is really step 2. What's step 1?
Step 1 is where you want to save that wealth, save or store the wealth to be able to do it. So your money, right? Like in order to do any of those things, you either need cash, right? Cash on hand in order to do it. Or what we bring and what we talk about is cash value. So cash value is a million times better at the end of the day. And that's what we it really is, I swear. And I can promise you, I can back it up. Back it up when we talk about it. And then you take that cash value and obviously you multiply it and you put it back into your business, real estate, those other things. But if you build up that cash value base instead of just the cash, you can have your money doing a lot more things for you, right? Like we can really multiply those real estate returns for you at the end of the day, which is what we do. So we're taking a strategy. It's not so, life insurance is the product, but really what we're talking about is the strategy, the infinite banking strategy, and being able to leverage and build our cash, build our wealth so that we can go out and we can invest in those 3 things so that we can become wealthy and we can, do what the rich do.
Yeah, and that's where it gets exciting. And so you talk about having this experience of feeling like you didn't have control. So what does control and compound? I mean, that's what your financial consulting company is called, but that's also what your podcast is called that people can check out as well on BNV, the same sort of platform that we make ours on. So what does control and compound mean? What are you controlling and what are you doing?
Yeah, so let's talk about a typical infinite banking policy. So let's say it's 10, 20, 30, let's just pick 25 grand a year or something. Someone is contributing to that. Okay, now most people, they're buying it for the cash value. So you're going to see, you're going to be a little underwater year 1 eventually, but after a couple years, like 2, 3, you're going to be at the point where your cash value is growing by more than your deposit. So if you're putting 25 grand in, your cash value is growing more than that. But that asset is, I believe the foundation is the most important part of a home or a building.
Yep.
The foundation of your financial plan, same idea. It's got to be rock solid and bulletproof. That asset is better than cash. It's uncorrelated to the market. In 2008, when everything crashed, these paid dividends of 7% and change. 2022, when everything crashed, these paid dividends. The dividend increased from 6% to 6.1% last year in the middle of meltdown on the stock market, Bitcoin, and the fluctuation in real estate. So you're totally in control of your money. So for me, that's the big thing. Control of my money, uncorrelated, not correlated to the real estate market, not correlated to the stock market. So that's the control. But for me, it's the second word, and. So what is an and asset? Every other asset you own is an or asset. You're going to buy this piece of real estate, or you're going to buy this landscaping business, or you're going to put it in the stock market. This is an and asset. That money is inside there, and that money is going to compound tax-free for the rest of my life. And I'm going to access it tax-free down the road, we'll get to, but that's going to compound tax-free for the rest of my life. So I'll give you a real estate example. I bought a fourplex a little over a year ago in Ontario. Now people go, oh, that's expensive. Well, it was 375 grand. We got a great deal, but it was in Cornwall, right? So it wasn't downtown Toronto.
Yeah.
So I had to come up with about 80 grand for that down payment. So I went to my infinite banking policy and I said, you know what? I like the way that's compounding tax-free. It's going to give me a tax-free retirement. Why don't we leave that right there? And I said to the insurance company, can you give me $80,000 of your money? And they said, sure. And the reason they said sure is contractually, the companies that we deal with, they're required to loan you 90% of your cash value, no questions asked.
Hey guys, we're jumping back and forth in between studios with this particular episode. We got more cool content with Control and Compound. I'm really excited for you guys to hear how you can leverage these policies and these programs to do creative things in real estate. And then we're going to pop back over to the other room, and we've got some Q&As. Neal does a breakdown of some really suspect geography. You can check that out. We've got other things that you guys have asked us, and we're going to get back to you. So you might hear your actual question there. Either way, you're going to take a lot of benefit from it. So keep listening. Thanks so much. Press the little ringy thing. Press the like button.
This guy.
So let me back this up for people, because for our younger listeners who maybe don't have any insurance at all, let alone a whole life policy, in lay terms, and correct me if I'm wrong about this, you're making these regular payments, okay, but part of them are maybe a typical insurance premium, and it's insuring you for X amount of a death benefit. So I pay in every month, and I've got death coverage to such and such amount. But in addition to that, some of the premium in one way or the other is being stored there in cash value. Okay, so while you have the death benefit on one side of the ledger, you also have this actual hard cash value sitting over here. And what you're saying about the dividends is that continues to grow effectively like a dividend, and expands and expands and expands. And eventually you have both the death benefit over here and a pretty significant chunk of cash. And what's cool about that cash is that it's growing tax-free, but also you can borrow against it. In the same way that you borrow against the equity in your home, you can borrow against the equity in your life insurance plan. Am I getting that right?
Yeah, 100%.
Yeah.
So on that example of the fourplex, so then I went to the bank, and the bank said, well, where'd you get the down payment? And I said, I borrowed from my cash value. And they said, cool. Because they don't consider that a loan for borrowing capacity. Technically, it's classified as an asset, because I could cash that out and take the money. It's not the great strategy. But so that doesn't count. That doesn't show up on a credit report, doesn't affect your borrowing
Do you
capacity.
pay interest on that loan?
You can pay it back when you want, how you want, and if you want. Because you are the bank. You make all the decisions. Picture you being in the bank making all the decisions. Well, this is what you are with your infinite banking policy. So I borrowed that 80 grand, cash flow positive property. Okay, so we got paying that back. It's actually 2 duplexes on one piece of land, so it wasn't as desirable for some. So we went through the process. We got it subdivided now. We've got to put a separate sewer line in, is what we're going through now. We'll get those subdivided. We think they're going to come in around 320 to 340 as individual units. Refinance that. Pay off the $80,000 plus interest. If I didn't pay the interest, you have that choice. Rinse and repeat. The whole time I did that, my compounding inside my policy is totally unaffected. So my money was in the policy growing tax-free for my retirement. It was providing a death benefit, and it was in the real estate at the same time. So I've multiplied my money.
So you the interest, you're choosing that interest rate, or is that being defined by the insurance?
That's being defined. So the interest rates, up till about 6 months ago, we were looking at, 4.7 to 6.
Yeah.
Now we're like 6 to 8, depending upon the rates have spiked up. For a lot of the companies.
But that's exactly in line with the home equity line of credit. So it's a very, very similar product. And we sort of joked about how the thing that is really frustrating about insurance is if you never have to use it, you feel like you've wasted the money. And this is the exception to that rule, where your money is working in 3 different ways. It's working to give you the death benefit, it's working to accrue over time as a cash value, and you can then tap into it. So you have the best of all worlds. And this is what finally got me excited about like insurance. I was like, oh, that's pretty damn cool. Because now when I fill out my net worth statement, I'm like, oh, my insurance policy has a cash value of like $100,000. And every time I fill that out, I'm like, oh yeah, I forgot that at any time I could go and borrow against that. So it really is cool. And the dividends that it pays are pretty good. And it's different than, say, if you had bought an investment that was paying this return and then you wanted to access that. It's a little trickier. You have the fees, you've got to sell, and all these things. In this case, you leverage it, and it continues to grow. So if there's $100,000 in there, it keeps growing while you just borrowed $90,000 of it. It's a really interesting product.
You can leverage against investments. I will say,
100%,
especially in
maybe
like
50% if you're lucky. You're not going to get a 90% loan.
unsecured investments. Exactly. I think GICs and secured investments, you can go up to 80-90% on those loans. This definitely does seem like a better play. I want to talk a bit more about the cash value, because I think a lot of people are going to be like, oh, like you sign up, you pay a monthly premium, and now he's got $100,000 cash value. You have probably contributed more than $100,000 off the start, right? And I think eventually it compounds where the cash value is more than you've contributed. And I think I was looking at charts, and it's probably in the 5 to 7 year range where kind of breaks over.
Yeah, but I'd say it's probably year 3 where you get to a point where your contribution, your cash value is going up by more than contribution, but you're underwater. That especially that year 1. So
Yeah.
by year 5, 6, 7, now what you've totally put in. But again, sorry, Christine.
Yeah, so I have something on that side of things with the cash value because I talk to a lot of people about these obviously every day, and they're like, yeah, it's about 7 years when my you're right, like around 6, depending on the policy, around 6, 7 years that it's going to break even, right? Is what you're looking at.
Yeah.
But in my mind, break even's actually, and when you think of it, break even's actually around year 2 because let's say you're using a $25,000 deposit, for example. Well, by year 2, you've put in $50,000, and inside this policy, there's usually around $40,000 or so, let's say.
Yeah.
So you've got $40,000 inside of this policy that's earning around 5% is what we see inside these policies, over time, around 5. So you're earning 5% on 40, but tax-free.
Yeah.
But I can also take $30,000 tax-free because I can take 90%, and I can go put that in a private lend, and I can make 13, 14%. So now I've actually got 70,000 working for my 50 because I have 40,000 earning, I have 30,000 earning. I would call that pretty darn break even, actually a bit more, right? At the end of the day. So that's how it's a mind shift when you're looking at it and the leverage piece. And this is why real estate investors like it so much because they get it, right? They know that if they can get it working in 2 places.
And do the same concept with real estate. Like you're leveraging, like when you start buying more and more, you're leveraging from your, like everyone's like, oh, it sounds like you just keep re-leveraging yourself. Well, that's what you're doing in real estate. If you have any loan, you're technically leveraging to make your next purchase or investment. At the end of the day, if you owe money anywhere, because if you that means that money's not paid off. That means you're paying an interest rate to utilize your money to make more money. So in real estate, you're basically borrowing your next down payment from your current property to do so. And so this runs that same concept. You're borrowing, and you can go out and reinvest that money and make money off of that, while your original piece of cash is also making money. But yeah, what were we going to say?
Well, I was going to say, when people used to ask me about the refinance model, and you refinance and buy and refinance and buy again, but you don't understand, I'm basically taking the same $60,000 and using it over and over and over again. I use it on a down payment
Infinite
property
money.
of this. I refinance, I take it back out, I do it again. So all I'm doing is actually just taking the same money and making it work further and further. And the other thing, and I know this is the least cool part about it, you're also covered in the event that you die.
Oh, yeah.
While all this is going on. So if you're going to get insurance anyway, this would be the one to get. Yes, the payments are higher, but you actually get the money back. And that's
It's an investment, it's an investor or savings plan, not an expense, right? Term insurance is an expense. It's like car insurance is an expense. You pay it, you're probably not
I think you
going
can
to
also pay it through your corp, can't you?
100%.
Sure can.
So that's
And it
pretty
works
damn
very
cool
well.
too. You pay it through your corp.
Probably the then it's a write-off,
Right,
is it not?
so-
Yeah.
It's not a write-off, but you
Okay.
get to use your corporate dollars, right?
Okay, corporate dollars. Okay. The next thing is the cash value guaranteed? Like, or how does that work? Because I remember reading on one of them that the cash value is subject to potentially changing. How does that work?
Yeah, so there's on a typical insurance, ledger spreadsheet, there's cash value guaranteed and cash value based upon dividends. So, we talk about real estate being around for thousands of years. Well, this has been around since 1846. So this is not a new product. We use 4 companies. The newest one we use has a 100-year track record. Of all those 4 companies, not one of these companies have ever missed a dividend, ever. World War I, World War II, .com, Spanish flu, COVID, you name it, they've never missed a dividend for 150 years. So we have that guaranteed column that if we have a nuclear war, I guess, would kick in. But in 150 years, none of the 4 companies have ever had to execute the guaranteed increase. So you get a small increase in the guaranteed, but based upon the dividends. But, you have these massive whole life funds with a 150-year track record that invest a lot like real estate investors. They invest in real estate, mortgages, bonds, a little bit in the stock market, but heavily in real estate and mortgages. So they're, again, that's where the money's been made. 90% of millionaires and billionaires, the whole life fund invests a lot like that.
Yeah.
One thing I want to add to that as well, though, is that once a dividend's been paid, it becomes guaranteed. So this can't go backwards. So once your cash value, that dividend gets paid and your cash value is sitting at 40, it can never be less than 40 again. So you can't lose it because the dividend goes backwards like the market was.
Yeah, because the dividend basically goes right towards your cash value.
And then it's
there now.
done.
Yeah.
It's guaranteed like every single year going forward. It's
It's
locked
not like
in
getting
for
another
you.
share that in turn could go down. Like if someone's
Exactly.
in some sort of drip, they might get issued new shares. But then if those shares go down, in theory, the dividend that they use has gone down as well. It's not the case in this. Now, when you refer to this, you say 2 things. Like, one, wealthy people do this, and I've got an interesting anecdote about this, which when something kind of clicked for me as well, is I had a client who was a very wealthy parent, and rather than them go out and get a bank mortgage, this individual, because they were so wealthy, could get a line of credit effectively or employ a line of credit. Maybe he was doing this exact strategy, and it was at a rate that was cheaper than the mortgage. He's like, no, I have access to a borrowing ability that, maybe he could borrow money at one way or another at 4%. So why would you guys pay a 5.5% interest rate? And that's how a lot of people do private lending. There's this misconception that all private lending is, some monopoly people back there with like stacks of cash and just issuing it out. In a lot of cases, it's that they have access to cheaper money than you do, right? If I have access to money at 6%, I will happily lend it out at 12.
If they're a business
Right.
person, they're not using cash. They're
Exactly.
borrowing money. Again, it's the same concept. Even if they have a loan on their personal home, but they're doing private lending with cash out of their accounts, that's the equivalent of them borrowing money to do it because they haven't paid off all of their loans. So
True.
people
Yeah,
will, like you said, long story short, people always borrow to relend, and that's the same thing with real estate. Like you said, we make a higher return than the cost of borrowing the money, and we're taking that margin and multiplying it.
Yeah, so just tell them private lending there, Neil. So I did a private lend last year, right? So I do some private lending, and it was actually a local guy here that had a building in New Brunswick. I think it was 36 unit or something.
Nice.
So I was in a second position, but he put up all of his 92 units in a second position, and I knew the guy was pretty comfortable with the risk. Well, it was 15% for a year for the private lend.
Nice.
I didn't use my money. Again, I went to my cash value life insurance. I had more than 100,000, and I said, "Hey, why don't we leave that? Let it grow tax free for the rest of my life. I can access it tax free in retirement." I called the insurance company and said, "Can I have 100 grand?" And they always ask you two questions. Typically, we call our office, but they'll ask you two questions: Do you want a check, or do you want to deposit it in your bank account? They don't ask you what it's for, when you're paying it back, if it's a good investment, if you really should be doing this. They gave me 100 grand. I loaned out 100 grand at 15%. A year later, I got a check for 115. I went back and paid the insurance company 105 basically,
Yeah.
and I kept that 10. That's an and asset. That's how many. So I look at my
And
wealth
meanwhile,
now.
your actual thing was still growing, and
Exactly.
you still had the death coverage. So it's
Exactly.
the
So my cash
trifecta.
value, so my money was doing more than one thing at the same time, and it was doing more than one job, right? And that's why I love real estate. Christine and I are both real estate investors. Is you put money in the stock market. What's your goal? Potentially one job. Your money goes up in value. But if we put it into real estate, well, we can have appreciation, we can do a reno, we can have cash flow, we get the power of leverage, we get the tax deduction. What else we got, Christina? Tenants paying down the mortgage. So you get these multiple jobs. Well, it's the same idea here. We're going to take some money and say, instead of doing real estate first, let's build an opportunity fund that when the market crashes isn't going to crash. And then when we go to do that, we'll borrow the money out, do the real estate, and through cash flow or refinancing, we'll pay that loan back, and we'll rinse and repeat. But by flowing it through the insurance policy, we've got that death benefit. You get the tax-free growth that you can use for retirement. There's all kinds of particular things. If you're terminally ill, they'll advance 25% of the death benefit. For me, I got to a point where I still had term insurance for my properties and look after my family if something happened. But my dollars going into cash value, pure cash value is why I was buying it, was doing another job, which was providing a death benefit. So I was able to gas $200 a month of term insurance that I no longer needed because this was doing another job. So it's multiplied dollars with multiple jobs in those dollars as opposed to one potential job in the stock market.
So I've got a big scheme, and you tell me if it's going to work out.
It's shaped like this.
It's pyramid in shape, and I'm at the top. I reach a point where the cash value of my whole life policy is a couple $1,000,000.
Yep.
I'm a little aged. I'm getting up there. And I just borrow against it, and that's how I live out my days. I borrow $1.8 million over a period of time, and that's how I ride out my days. And then I die, and the policy covers what I borrowed anyway. But I've borrowed that $1.8 million tax-free.
Yeah, so let's talk about that. So let's say $1.8 million, let's say your death benefit's $3 million. Okay, so now you're 65, 70 years old, and you go, it was a good run, Darren. I leveraged this 12 times. I got to whack more properties. I don't want to do that crap anymore. I just want to chill on a beach, spend this money. So we can go, okay, well, let's set up you can do lump sum, but typically people will do annually. Why don't I borrow 180 grand a year, say? 180 grand a year, that's a loan. That's tax-free money.
Yeah.
So
We're
that's
paying
going to be
interest on it, but the interest is way less.
right.
Than
But
the tax.
when you're older, we can actually capitalize that interest. So you're being charged the interest, but it's going to capitalize. But here's the cool thing: if you had $1.8 million in the stock market and you started spending that, the next year you'd have 1.6 something, 1.4 something, 1.3 something.
Right, because
You're not cashing out the cash, but no, not because you're
Because
depreciating the
you're gonna
capital.
sell- selling
Because
it.
you're
Oh, I see what you're
depreciating the
saying. Yeah,
capital.
yeah.
Here, you're 1.8 million. Well, 10 years later, that's probably going to be worth 3.6 million.
right. I got
Because
more
that
tap
money's
into.
continuing to compound. So we're not interrupting the compounding. It's continuing to compound.
Right.
So now that money that you take out, you could take out a lot more on that loan because now you could retire and still compound uninterrupted for another 30 years.
Right.
So the amount that you can take out on these loans tends to be higher than a traditional investment. And that's just the kicker at the end, the bonus. Tax-free retirement income. It's what can you use in the first 20 years to multiply your assets.
Yeah.
When you say you can capitalize the interest for somebody at let's say the end of their policy, what does that look like, and what exactly is that?
Yeah. So if you take a $100,000 loan and you're going to be charged 5 or 6% interest, you get the option to pay that, or you get the option to just let it ride. And we don't encourage people to let it ride long term when they're young because, we love the snowball analogy, compound interest. It's like a snowball, right? You roll it, roll it, roll it. Well, we want to roll a snowball for 60, 70 years. That's one big old snowball.
Yeah.
Most people, the snowball gets eroded through taxes, fees, or they spend it, right?
Yeah.
We never need to spend it. So we're going to do that forever. Where's it going with this, Christina?
Well, yeah, the capitalization
Oh,
on
there we
the
go.
on the interest rates, but we use a line of credit, right? So you're not going to take the whole amount in every single year. Like you said, you're going to take 180,000. You're paying interest that year of 180,000, but we've got 1.8 million that's earning dividends.
Right.
Like you can very easily keep up with this. In
Yeah,
a couple of
6%
years, you're
interest rate, and
3.6.
you're making a 6%
Yeah,
dividend.
exactly.
You're
That-
actually on a higher amount. You're actually going to still be making more money,
And you do.
even paying the interest.
Exactly.
Exactly.
That's
So
the
you
whole
just let it
idea
roll.
of
So
the
my scheme's going to work, is what you're telling me.
Yes.
And here's the great thing.
It's all coming
So
back, Chandler.
tax free.
Pyramids are still
But
there.
here's the great thing. I know you got kids and you got all kinds of properties. Well, I always tell people, I go, this is the cool part. Great. In your example, I'm going to have $1.8 million of cash value, $3 million of death benefit, whatever the number is. So at that point, you can choose what you do with that money. You can say, you know what, maybe I want to spend up to $2 million owing because my cash value will grow to 3 or 4. Maybe I want to spend like $2 million while I'm living and leave a little bit to my family because there's always going to be something left for your family because the death benefit's always up here. The loan's going to be a little lower. The cash value is a little lower and the loan's 90%. So there's always a spread between death benefit. So, it's great. You get to spend that, $1.8 million and your family gets $1.2 million. Or maybe you want to spend 2.5, leave your family $500,000.
Seems a
Or
little
maybe
better.
you're going to be really rich, continue to be wealthier, and you're going to reach a point and you go, well, maybe I don't need to access this. I still like having it for the emergencies in retirement, but maybe I can leave that full $3 or $4 million death benefit to keep the family legacy going and to keep
Well, to
these
pay off
properties in
any-
the
yeah,
family,
exactly.
pay off debts, don't have to have fire sales, etc.
Yeah.
Yeah, one of the best things about it is you've kind of cut CRA from your plan as well, right? Because they're not getting it when you spend it, and they're
Yeah.
not getting it when you die anymore.
And
kind of.
I'm buying it through my corporation dollars as opposed to personal dollars.
Last question I'm going to ask you guys is, can you modify the amount that you're contributing, and do you have to lock that in advance? Kind of the way I've understood is you kind of have to pick okay, for the next 5 years I'm contributing $25,000 a year. Is that the case, or is it every year you can be like, this year I'm going to do 100,000, next year I'm going to do 200,000, and how does that impact things? Is then your end value, the premium the value at the end is worth a ton more, and I don't mean cash value, sorry, the payout, the death benefit. Does that change dramatically? Are you able to kind of move it around? From my understanding, I feel like you have to pick your terms within that.
Yeah, it's typically fixed. So I have 8 of these policies. And the reason I have 8 of these policies
okay.
and I put, significgrand
Like a
sums
cat.
I have 8 lives. I have 8 policies. So I have 8 of these, but it started out going, grand $1,000. Was this good idea? And then it's like, well, this is a really good idea, and it's actually working like they said. And then now clients come back to us and buy multiple policies. So yeah, you're kind of fixed at that thing. Now, if you got a lump sum coming in a year or two, we can build it in to say we can accommodate that. But you go back to Chandler, you talked about, you pick a death benefit. We actually don't pick a death benefit. That's the way traditional advisors going to do. Insurance agent, right? How much death benefit you want? $1 million. Oh, you can do this and you can have cash value too. We're the exact opposite. We're trying to design this contract. This is what we specialize in, to be the most efficient possible. And the way we design that is we want the smallest death benefit legally required for this amount of cash. So we start with, okay, you want to do $25,000 a year? Great. Well, at your age, the smallest death benefit we need for that is $436,116. And that'll be your starting death benefit. Not a round number, because we want it efficient as possible. And that means we're going to maximize the cash because we have the smallest insurance costs.
Right.
So
Yeah.
that's the...
We've got
And
some
it-
flexibility. We've got some flexibility around it too. Like you kind of decide on the deposit that you want to do, but when these are built correctly, there is flexibility in the deposit amount. So there's a
Okay.
lot of advisors out there that don't set them up correctly, and you have to be careful. There should always be a flexibility amount between a minimum amount that you can be putting in there each year and a maximum. You always want to maximize it. Maximizing is always the best.
Yeah.
But from a, okay, well, what if I have a bad year perspective and business kind of thing, we do have wiggle room on that side of things as well. So that we can structure it, and we do have some flexibility to work within a
And
plan.
full disclosure, like
Yeah.
they are a bit more expensive than a term insurance policy. Like you are making larger contributions because of what they do.
but it's not an expense, right?
not an
like
ex-
it's somewhere
putting
you
money in
want
your-
to put
putting
it,
money in your bank
right?
account is not an expense.
It's a savings
Yeah.
plan. So
Exactly.
That's
The
a-
death benefit's
that's a
just a
great point.
bonus, right?
Yeah.
Well, it's a very good
Yeah.
bonus, but it's on there, right?
I know you've talked about a few things in the book. Is there anything here that outlines maybe any cons or risks to doing this?
Yeah, I mean, the biggest risk of this, and when we go through this, great, we have clients come to us all across Canada. We work coast to coast, and we call it our education session. So the first thing is an hour education session, and we go through sort of the pros and the cons. And really the big con is if you can't come up with premium number 2, you're screwed.
right.
You're screwed.
Yeah.
Now, most insurance contracts, you could have zero cash value for 10 years or term insurance, 0 for life. So if you're in year 7 and you miss a payment, boom, policy's gone. Because we're so front loading these with cash and minimizing the insurance costs, once you reach the second year, which is typically, if you're paying annually, is 12 months in a day, right? You pay once now and you pay again in 12 months. Now we're at a point where if something hits the fan and you got a bunch of projects on the go or something to go, a roof goes, you can choose not to make a payment for that year. You can you'll have enough cash value after 2 years to borrow from your own policy if you want to
Oh,
make
yes.
that $25,000
Yeah.
deposit. And again,
Yeah.
99% of policies are not designed that way, that if you can't come up with year 3 or 4 or 5, you're screwed. And that's why working with so many real estate investors, flexibility is the key. Flexibility and just maximum efficiency as far as cash goes.
So I got a couple questions maybe just to wrap us up here. First is it cool if we give away these to someone that's listened to the episode?
Absolutely.
Okay, so we're gonna have all the details in our post about this, but you guys are willing to take on a complimentary consultation, I guess, with listeners who are interested.
Yeah, Christina, why don't you
cool.
talk about the front of the line that we've got set up for the Master Key listeners?
Yeah, we have a website. You go to controlandcompound.com/masterkeys, and you're going to be able to get a complimentary VIP session with one of our wealth coaches. So you can take that education session that Darren talked about, kind of the first step to learning more about infinite banking.
Cool, we'll definitely promote that. And again, some lucky people will get a copy of this book. Otherwise, how can they reach you?
Yeah, through the website, so controlandcompound.com. We're also on, Instagram at Control and Compound, TikTok. We've got our podcast, Control and Compound, there as well. I know you guys are going to be on it in a couple weeks too, so you're going to want to check those out. So anywhere, wherever you guys are, we pretty much are too.
That's awesome. Again, this is one of those topics that it's almost like people don't know that they should know about it. You know what I mean? So I think education, we talk about that. We're big promoters of education. Learn. This is something that if you're serious about this, it's going to have to be a tool. It's going to have to be something in your long-term planning. And I know a lot of our listeners, you're young, you're not necessarily thinking that far ahead, but everyone knows a snowball, the earlier you can get it rolling, the better. And this is something that if you can make it work, it's going to pay off for sure in dividends, no pun intended.
Oh, no. Take on a policy. I'll say that for the young listeners. Take on a policy now because the rates are so much more favorable than as you get older. But
Yeah.
thanks, guys. Appreciate it.
Thanks so
Thank
much
you.
for
Thank
coming
you for
on. That
having
was
us.
awesome.
Thanks, guys.
Thanks.
We good. We're back. Switching back here for the last segment. Thanks for listening to this point. We're going to whip through some questions that you guys have put on our various platforms. We really want you guys to continue doing that, and we will get to responses. We're going to put them both online, but also cover some of them here so that everyone can benefit.
100%. I'm just going to get them up. Everyone's got to stand by and listen to me click away here. How's life?
Life's good, man.
Yeah?
Life's good. I'm excited. Neil's waking up early these days. We're waking up early these days. It's ramp up time. It's that time of year.
Yeah, I'd say in the last 10 days, I've probably woken up 7 days pre 7 a.m.
Yeah.
Which is kind of insane.
There's going to be people out there that wake up at 6 o'clock every day or 5:30 and be like, that's pathetic. But hey, little steps to everyone. Everyone's different, but starting your day early. Have you noticed a difference?
I very much have noticed a difference. The biggest thing is my days feel like long and full, which is exciting. Like I do a bunch of stuff and I'm like, holy shit, it's 3 o'clock. Whereas I used to always do a bunch of stuff and then it was 6 and then I was like, I gotta go to the gym. And it just kind of I always felt like I was catching up with every day that I was doing. And really the time that I was wasting was from 10 to midnight, which I was nothing of any value was taking place.
Yeah.
And so now I've just shifted that away. And so like if I can get to the point where I'm getting up at like 6 comfortably, going to the gym, then I think my day will be so locked in. But I got to say, if someone's listening to this point and they're like, oh, that's pathetic that he hasn't been getting up, we are all different and you can succeed in your own ways. Like I like to work at nighttime. So 11 o'clock at night, I'm on my computer working.
However,
also, I don't necessarily feel like I have to justify it because I'm like,
hey, live your life.
I live my life the way I want to live it, and the business has done well for what I wanted it to do, and it kind of worked on that. And realistically, as a real estate agent, not a whole hell of a lot's going on in the morning. We're evening people. Like everyone's got to do their showings in the evening. You're doing offers at night.
However,
kind of worked out, but it's better to run it like this.
Yeah, and if you believe in emulating success, a lot of successful people, one
100%.
habit they share is getting up earlier. You're more effective. It's great.
I like emulating
great
sleep.
time. I like emulating sleep with people.
All right, I got the questions open. I am going to read the first one.
Yeah,
and we're going to try and talk them over.
Okay.
So, Michael Tompkins, thanks to the new heat on the Airbnb subject. Still interested to know if their map of what is allowed is a hard commercial or residential property or an actual zone where they may be allowed. So, to summarize that, I think what he's asking effectively is there set zones and areas,
like a drawing, on the map,
drawing similar to what we had here of like a center plan that says you can have Airbnbs in these areas, or specifically within these commercial zonings, you're allowed to have it, which you can then go to the map and see.
Yeah, the answer
is no.
Well, the answer is kind of yes and no. Like, there's not going to be like we have the center plan now in the first package, right? And so the center plan is not complete in that it's going. They're starting with the core and they're going to work their way out slowly from there. But what has been completed is effectively that map as to where Airbnbs are going to be allowed. It is going to be designated effectively a commercial use. So if it's a commercial area or if it's an area that allows commercial use, that will permit an Airbnb. The second component is if it's in a residential area, it only allows for short-term rental if it's in your primary residence. So there you go. If you have a map that shows commercial and residential, you have the map of Airbnbs. It's just different rules for each area. There's nothing that's going to say unilaterally you cannot do an Airbnb in this area, because if it's a residential area, you can do one there provided it's your primary residence. And that's going to be the big hiccup for people. And that's going to be municipality by municipality.
But on the flip side, commercially, you can do some really unique things like commercial spaces, commercial condos could be converted into Airbnbs. The biggest thing to consider is if you do that and you go through the permitting process, there's going to be some pretty intensive fire regulations because it's short-term residential usage.
Also, your condo board could
your condo board could hate that. But if you own the building, it's got commercial space, let's just say, it could have some serious ramifications on what is required for fire code. I've seen that in a few buildings that have been short-term rentals or motels, whatever it is, and then the new fire code comes in, and you don't get grandfathered in with that kind of stuff.
Yeah.
You have to bring it up to code, and it's unbelievably expensive. Yeah. But anyways, okay, moving on to the next question. Ben LeBlanc, on the subject of pulling equity from your home, how does someone know what renovations add the most equity to a home? Well, you listen to the Master Keys podcast. That's the first answer. Actually, check out our Patreon because we really get into it there. But I always say the one way to do it, like on an easy basis, is like, first of all, brands don't really make a difference. Our house prices aren't at a level where it's like, oh, this super fancy whatever is worth $5,000 more than the next one.
Yeah.
That kind of stuff. It's like, okay, it's a brand new toilet. It's a brand new toilet. But renovations that create a big visual upgrade, right? When you think of things that when you walk in the door, they're going to make a big change. It's like if you change the flooring to a modern color, that's going to add a ton of value. If you go and do a kitchen
Yeah.
and bathrooms are worth a fortune.
Yeah,
Countertops,
appraisals.
stainless steel appliances, like those are all check boxes on their list. Those are items that I say are worth doing. But as a whole, you just got to make the property look and feel good. Because the other thing is, on top of the checklist, an appraiser's a person. And so if they come and the property feels really nice, it's a lot easier for them to justify through photos in their list that this is a decent property.
Yeah, I'm going to add some nuance to that. Like the first thing is remember that appraisal is meant to be a best estimate of market value. So anything that's going to raise market value is going to raise the appraised value. So these are things like kitchens, obviously, and bathrooms. They have a major impact. Curb appeal, all these things, the overall level of the finish is going to have a positive impact on your appraisal. The other thing, though, appraisers do a lot by square footage and room counts. So if you can add an extra bedroom, or you can add an extra bathroom, or you can just finish more square footage, that is going to have a huge impact on your appraisal value. So an unfinished basement that you convert to like add an extra bedroom, add an extra rec room, and add an extra bathroom, that's huge, right? Because then they're looking at literal price per square foot, and that's going to skyrocket your appraisal value.
And or an in-law suite as well. If you can add an in-law suite, those things are also super valuable because it's another home effectively.
And we're talking like single-family residential there. If you have multi-unit, rent and cash have a big impact on your appraisal. Net income, right?
It's all rent. Like it's income based. But next question, Ernest Stapleton. How can you structure a sale of ownership in a property that is allowed inside your mortgages? Can you sell 25% of the upside with a min and maximum appreciation rate, allowing you to move all your cash used at the time of purchase? I think what they're suggesting is they own a property, they're 25% in, and they're looking to sell out to an equity partner. So that equity partner is buying 25%, and they're saying that gives them their 25% cash back, and the other 75% that they own is actually effectively 100% leveraged.
Okay.
Do you know what I mean? Which is kind of clever. I've never actually thought about it like that. I'm going to automatically say no because the overruling body in this is going to be your bank. When you sign that bank mortgage, there's going to be a bunch of rules in there regarding selling fractional ownership and all that, and they're going to expect that if the deed changes, they're going to get updated by your lawyer, and when the second that happens, they're going to be like, whoa, we're getting paid out 25%, and you're getting back 25%.
Well, the issue is as soon as you change title, you have to change the mortgage, right? Like, so the only instance that this scenario could work would be if you owned the property in a corporation, and in turn that corporation had shares. So, for example, if Neal and I, owned a property under our corporation, and we had 4 shares, maybe Neal had 2 and I had 2. If we wanted to, we could sell one of the shares in our company to someone else, and that doesn't change title because the title of the property is our corporation. Now, the
Still
nuance
have legal
of that,
obligation to notify the mortgage company.
yeah, totally. Like they will wonder who are the shareholders. And now the interesting thing is, though, could that share purchase be then releasable to the other shareholders right away? Like there is something interesting there that I haven't thought about.
No, I am 100% that you have the second you make any sort of changes to a share structure with a commercial mortgage, you absolutely have to let the mortgage company know.
Oh, 100%.
And if you don't, fine, nothing's going to happen. Like you can do it, nothing's going to happen. But the second your annual review comes up, they're going to hit you with like either this needs to go or you've just done mortgage fraud.
Oh yeah, I'm not saying that, but I'm thinking of a scenario whereby.
Yeah, I think you can. We can sell. Let's say I sold one share to Mark to jump in for $100,000. We could then withdraw that cash instantly. Nothing's going to happen. No one audits that officially until the end of the year when they're going to ask for the books.
Yeah, and if like the corporation, like that would be money into the corporation, right?
Yeah.
And then you could withdraw that as a dividend,
You would
or
get
even
so
a
much
shareholder loan, right?
You would get in so much shit for the change of ownership without telling them.
No, I'm not saying not telling them. I'm just saying you would tell them that there's an additional shareholder in this corp. But if they're like, okay, fine, there's an additional shareholder in this corp, but you still have 25% equity in the property. But then behind the scenes, like there was also this injection of cash into that corporation. Yeah. And if that corporation then wanted to make a shareholder loan or a dividend payment to you and me, there's something kind of there.
There is kind of something there.
Consult your accountant, but I like where your head's at.
I want nothing to do with this on the mic. Off the mic. No.
Maybe this is a Patreon episode.
Yeah. And you're coming on to explain this one to us.
You guys got to check out the Patreon, man. That's where we get into the dirty nitty-gritty.
That's our OnlyFans, guys.
That's right.
So, okay, we got a couple off Instagram here. Ty Doucette wants to hear about capital partners, structures, and payouts. That's definitely Patreon. we talk about that.
We
there's
talk
not
about
much-
JVs.
There's too much to talk about there. There's 1,000,001 structures. It's pretty much one of the best ways to grow if you want to do it in an expedited way. I've done it to buy a few properties.
Even Ty might have found what we just talked about with shareholder setups of a corporation
Some value.
kind of relevant. Yeah.
Yeah, but Ty, check out the Patreon. We are going to do a free month here some point in time. Next one is Mike Harris. What systems need to be in place to manage an STR and or long-term rentals from afar? So STR is a short-term rental, and he's asking how to do this from afar. There's no great
I'm going
way.
to put my microphone away because I'm not the person to ask about this.
Yeah, exactly. Chandler is, if anything, ingrained into his system. I can say, being someone who's kind of checked out, I hired a property management company. I've gone through a bunch of them, and I really struggled. Like, no one's going to care about your investment or your property like you do. And so I honestly believe you will lose way more money than even the little bit of management fee that they charge. I now have a full-time person, Josh. Shout out if he's listening. He's amazing. And he allows me to...
Feel better soon, Josh.
He was nasally this morning. But he's allowed me a lot of freedom to invest in other businesses and also travel. But it costs me a lot to do that. And I'm spending as much or more than I would be if I had hired a management company.
Here's what I think you need.
There's no set way, I think, honestly, to handle it. A
I think
superintendent with a good manager.
Yeah, if you're talking short-term rentals from away, I think you need lawyer, accountant, real estate agent to understand the nuance of the particular municipality you're investing in and the possible zoning ramifications, and in turn possible
I think he means
tax
once you own
ramifications.
it, though. Like
but once you own
running
it, you need effectively a property manager, which is going to be 20%, and that property manager is going to already have the systems. If you're trying to do this as a one-off, you're literally like going to individually hire a property manager, individually hire a lawn care company, individually hire a maintenance person, and then individually hire a cleaner. Or you just get the all-in-one property management company who will charge you probably around 20%, but they will already have
For Airbnb,
those staff.
30.
30, eh?
Yeah.
Okay, maybe my deal's not too bad at 20%. But on top of that 20%, it's 20% plus paying a cleaner, plus someone to mow the lawn, right? But someone else should have all those systems in place for you, but maybe you get up around 30%.
Fight me on this, but I think it's easier to manage a short-term rental from a distance than a long-term. Because you pay these companies 25-30% and they actually run it and they get paid on the fact that they're going to get a bunch of rentals. So it's easier to do it. Whereas I find with the long-term rentals, like the people aren't
But then you're not
managing
managing it.
What?
But you're not managing it. Someone else is managing it. So you can't say it's easier to manage one
Well,
when you're not
it's
managing it.
It's easier to own one.
It's easier to own. Okay.
In my opinion.
From a
if you
distance.
have
Yeah,
a
that's
good
interesting. That's
company
an
that
interesting
runs
thought.
it.
Yeah.
The next two, again, these are like things that people want us to talk about. So we're going to actually do actual episodes. One, Heman J11, migration across the country. We're just going to make an episode out of that, but a lot of you guys already know there's been a huge migration of people from west to east. I think predominantly the west was more favorable, I think, for climate and then also financials because your proximity to Asia. And so there was a lot of money being made in the west. And I think that started to slow down and peak. And so what's happening is you're seeing people move to the east because it's a lot more affordable. And there's a lot of great opportunities arising on this side, especially from my opinion, due to the proximity to India, which is now blowing up North America. So, anyways, we'll do an episode, I think, on migration. I like that.
Is like the East Coast closer to India than the West Coast?
I don't necessarily know if it formally is, but I know a lot of Indians are moving to the East Coast.
Is it informally closer?
This guy. All right, we're going right now. No, we're doing it. We're doing this. Halifax to India distance.
Like, well, it's not formally closer, but it's
Informally, there's a better direct route.
I actually took intro to informal geography in high school, so a bit of a savant. This guy getting out the latitude and longitude. See
it is. So it's 11,936 kilometers, Vancouver to India. Okay. And Halifax to India is 11,818 kilometers. So it is 128 kilometers closer to go to Halifax than to go to Vancouver.
Corrected.
So formally, the East Coast is closer to India. Okay. Moving on. Next question.
Good to know. It's that 100 kilometers that gets you. That last 100 kilometers of jet lag.
The prices really they skyrocket.
Yeah.
So last but not least, Paul Fraser Realty. He asking us to talk about age and attrition. I think we talked about that a lot near the start when we were talking about like open bid and all these online systems. But I think we should go over it again because I think it's going to become a lot more relevant here as time continues. Again, technology, the issues that we're having here with people like stealing properties, like a lot of things are continuing to lean that way. And I'd like to revisit it with some of the technology. And I'd love to talk to some of those people who had businesses that started when the market was booming and seeing how they're faring. With these bidding based systems.
Well, look at Zillow got crushed because they were trying to do Zestimates and make that, and they got absolutely smoked.
Yep.
So that's an example. All these iBuying companies in general that were huge in COVID, they're effectively out of business.
Yep.
So there was a lot of turnover in the tech part of it because it turns out there's more nuance to this
Selling a
whole
home.
selling home thing than some might think.
It's a little more formal than you think.
It's a little more. It's formal and informal when you think of it. But
That's enough for today.
Yeah.
Thanks for listening, guys. This was a longer episode. Leave your questions in the comments on YouTube, Instagram, wherever you're at. And again, thanks for listening.
Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.